Your money is losing value right now. Every single day it sits in your bank account, you're getting poorer. Kevin O'Leary, the millionaire investor from Shark Tank, says keeping cash in the bank is one of the biggest mistakes regular people make. And the wealthy, they stopped doing that decades ago. In the next 20 minutes, I'm going to show you the exact 5 assets rich people use instead of traditional savings accounts. These aren't complicated. You don't need millions to start. And by the end of this video, you'll know exactly where to put your money to protect it and actually grow your wealth. Let's get into it. Welcome back to the channel. If you're new here, this is where we break down real wealth building strategies that actually work for everyday people like you and me. Before we jump in, quick question. How much cash do you currently have sitting in your checking or savings account? Just think about that number. Now here's the problem. With inflation running hot and banks paying you almost nothing in interest, your money is actually shrinking in value. Kevin O'Leary recently said in an interview that keeping more than 3 to 6 months of expenses in cash is financial suicide. So what should you do instead? The wealthy have a playbook. And today, I'm sharing 5 assets they use to keep their money safe and growing. Make sure you stick around until the end because asset number 5 is something most people have never even heard of, but it's one of the safest wealth protection tools on the planet. All right, let's dive in. Why banks are a bad place for your money. Okay, so let's talk about why keeping your money in the bank is actually costing you money. I know that sounds crazy, but hear me out. The inflation problem, think about what a gallon of milk cost 5 years ago, or a dozen eggs, or a tank of gas. Everything costs more now, right? That's inflation. Inflation means the same dollar buys you less stuff than it did before. Right now, inflation is running somewhere between 3 to 5% per year. What does that mean for you? It means if you have $10,000 sitting in your bank account, in 1 year that money can only buy what $9,500 could buy today. You didn't spend a penny, but you still lost $500 in purchasing power. That's the invisible tax nobody talks about. What banks actually pay you? Now you might be thinking, but wait, my bank pays me interest, so I'm making money, right? Well, let's look at the numbers. The average savings account in America pays about 0.3 to 0.5% interest per year. Let's be generous and say you're getting 0.5%. So on that same $10,000, your bank is paying you $50 a year. 50 bucks. But remember, inflation is taking away 3 to 5%, which is $300 to $500. You're losing $250 to $450 every single year, even though you think your money is safe in the bank. The opportunity cost you're missing. Here's what makes this even worse. While your money sits there losing value, the bank is using your money to make massive profits. They loan it out at 6, 7, even 20% interest on credit cards. They invest it, they make money hand over fist. And what do they give you? Crumbs, 0.5%. It's literally the worst deal in finance. This is what Kevin O'Leary means when he says keeping cash in the bank is financial suicide. You're guaranteeing that you'll lose money. The wealthy understand this. That's why they move their money into assets that actually keep up with or beat inflation. Think about it like this. If you have $20,000 in a regular savings account for 10 years, inflation will eat away nearly $10,000 of your purchasing power. $10,000 gone, just evaporated. That's money you worked hard for. Money you could have used for retirement, for your kids' education, for building real wealth. Instead, it's slowly disappearing while the bank gets richer. So if banks aren't the answer, what is? Let's talk about what the wealthy do differently. Asset number 1, Treasury bills and government bonds. So the first asset rich people use instead of traditional bank accounts is something called Treasury bills, or T-bills for short. And before you think this is complicated Wall Street stuff, trust me, it's actually super simple. What are Treasury bills? Treasury bills are basically short-term loans you give to the US government. You're lending Uncle Sam your money for a specific period of time, and the government pays you interest for that loan. These come in different time frames. You can get T-bills for as short as 4 weeks, or up to 1 year. The most common ones people use are the 4-week, 13-week, and 26-week T-bills. When the time period is up, you get your money back plus the interest. Simple as that. Why rich people love them? Here's why wealthy investors like Kevin O'Leary park massive amounts of cash in T-bills instead of banks. First, they're backed by the full faith and credit of the United States government. This means the only way you don't get your money back is if the entire US government collapses. And if that happens, we've got bigger problems than our investments, right? So they're considered one of the safest investments on planet Earth. Second, the returns are way better than bank accounts. Right now, T-bills are paying around 4 to 5% interest. Remember how we said banks pay you 0.3 to 0.5%? T-bills are paying you 10 times more. On $10,000, that's the difference between making $50 and making $400 to $500 a year. Third, the interest you earn from T-bills is exempt from state and local taxes. You still pay federal tax, but if you live in a high-tax state like California or New York, this is a big deal. It makes your actual return even better. How you can start today. Now here's the best part. You don't need to be a millionaire to buy T-bills. You can start with as little as $100. You buy them directly from the government through a website called treasurydirect.gov. You create a free account, link your bank account, and you can start buying T-bills in minutes. No broker fees, no middleman taking a cut. You're going straight to the source. Kevin O'Leary has said in multiple interviews that he keeps his emergency fund and short-term cash reserves in T-bills, not in a bank account, T-bills. Because why would he accept 0.5% when he can get 4 to 5% with the same level of safety? Here's what I recommend. Take your emergency fund, the 3 to 6 months of expenses you need to keep liquid and safe, and move it from your regular savings account into T-bills. You can ladder them, which means buying T-bills that mature at different times. For example, buy some 4-week T-bills, some 13-week T-bills, and some 26-week T-bills. That way, you always have money becoming available if you need it, but you're earning way more interest than any bank will ever pay you. This one change alone could put hundreds or even thousands of extra dollars in your pocket every single year. Same safety, same security, just way better returns. That's asset number one. Now let's move on to asset number two. Asset number two, high yield savings and money market accounts. All right, asset number two is something you're already familiar with, but with a major upgrade. We're talking about high yield savings accounts and money market accounts. Not all savings accounts are created equal. Here's something most people don't realize. Not all savings accounts pay the same interest. In fact, there's a massive difference between what traditional banks pay and what you can actually get. Your local Bank of America, Wells Fargo, or Chase, they're paying you around 0.3% interest. That's insulting, honestly. But online banks, the ones that don't have thousands of physical branches, are paying 4 to 5% right now. Same FDIC insurance, same protection, same safety, but you're earning literally 15 to 20 times more interest. This isn't a small difference. On $20,000, that's the difference between making $60 a year and making $800 to $1,000 a year. The online bank advantage. So why do online banks pay so much more? It's simple economics. Traditional banks have massive overhead costs. They've got rent for all those branch locations. They're paying employees at every branch. They've got utility bills, maintenance, security. All of that costs money, and they pass those costs on to you by paying terrible interest rates. Online banks don't have those expenses, no branches to maintain, lower staff costs. They pass those savings directly to you in the form of higher interest rates. Some of the best high-yield savings accounts right now are from Marcus by Goldman Sachs, Ally Bank, American Express Personal Savings, and Discover Bank. These are legitimate, well-established financial institutions. We're not talking about some sketchy operation. FDIC protection still applies. Now, I know what some of you are thinking. Is my money safe with an online bank? Absolutely. These accounts are FDIC insured up to $250,000 per depositor, per bank. That means even if the bank goes under, the federal government guarantees your money up to that limit. It's the exact same protection as your local bank. The only difference is you're accessing your account through an app or website instead of walking into a branch. And let's be honest, when was the last time you actually went inside a bank branch anyway? Most of us do everything online already. Perfect for short-term savings goals. High-yield savings accounts are perfect for money you need to access relatively soon. Maybe you're saving for a down payment on a house. Maybe it's for a wedding, a vacation, or a new car. This is money you'll need within the next 1 to 3 years. Unlike T-bills, you can withdraw your money anytime without penalties. You've got complete flexibility, but unlike your regular savings account, your money is actually growing at a rate that keeps up with or beats inflation. Kevin O'Leary and other smart investors use high-yield accounts as a parking spot for cash they might need in the near future, but want to earn solid returns on. Actionable tip. Here's your homework. This week, open a high-yield savings account. It takes about 10 minutes. You'll link it to your current bank account, transfer your savings over, and immediately start earning 10 to 15 times more interest. Calculate how much you're losing right now by keeping money in a traditional savings account. Then make the switch. Your future self will thank you for those extra thousands of dollars. That's asset number 2. Now let's talk about asset number 3, where things get even more interesting. Asset number 3, dividend-paying stocks. Now we're getting into asset number 3, and this is where wealthy people really start building serious passive income. We're talking about dividend-paying stocks. How rich people make money while they sleep. Here's a concept that changed my entire perspective on money. What if your investments paid you regularly, like a paycheck, just for owning them? That's exactly what dividend stocks do. When you own shares of certain companies, they pay you a portion of their profits every single quarter. You don't have to sell the stock. You don't have to do anything. You just own it, and money hits your account every 3 months. Kevin O'Leary has said repeatedly that dividend income is his favorite type of income because it's predictable, it's passive, and it compounds over time. Blue chip dividend stocks explained. Now, not all stocks pay dividends, so you need to be strategic here. You want to focus on what are called dividend aristocrats. These are companies that have not only paid dividends, but have actually increased their dividend payments for 25 consecutive years or more. We're talking about rock-solid companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, and Walmart. These aren't risky startups. These are companies that have been around for decades and will likely be around for decades more. Think about it. People will always need toothpaste, medicine, food, and household products. These companies make steady profits year after year, and they share those profits with shareholders. The power of dividend reinvestment. Here's where it gets really exciting. Let's say you invest $10,000 in a dividend stock that pays a 4% annual dividend. That's $400 a year paid to you in cash. Now, instead of spending that $400, you reinvest it to buy more shares. Those new shares also pay dividends. Next year, you're earning dividends on $10,400 instead of $10,000. The year after that, even more. This is called compound growth, and it's how wealth is actually built. Over 10, 20, or 30 years, this snowball effect becomes massive. Your initial $10,000 could grow to $50, $70, even $100,000, all while paying you increasing income along the way. Warren Buffett, one of the richest people on earth, built his fortune largely through dividend-paying stocks. Kevin O'Leary structures his entire portfolio around dividend income. This isn't theory. This is the proven playbook of the wealthy. Important risk note. Now, I need to be straight with you. Stocks can go down in value. Unlike T-bills or savings accounts, the stock market fluctuates. Some years you'll see gains, some years you might see losses. That's why you should only invest money in stocks that you won't need for at least 5 years, ideally longer. This gives you time to ride out any market downturns and benefit from long-term growth. If picking individual stocks feels intimidating, start with a dividend-focused index fund or ETF. These funds own dozens or hundreds of dividend-paying companies, so you get instant diversification with one investment. Look into funds like Vanguard Dividend Appreciation ETF or Schwab US Dividend Equity ETF. You can start with as little as $100 in most brokerage accounts. This is how you start generating real passive income. Asset number 3, dividend-paying stocks. Now let's move to asset number 4. Asset number 4, real estate investment trusts, REITs. Asset number 4 is one of my personal favorites because it lets regular people invest like real estate billionaires without needing hundreds of thousands of dollars. We're talking about REITs, which stands for Real Estate Investment Trusts. Own real estate without buying property. Let's be real. Most of us can't go out and buy an apartment building or a shopping mall. You'd need millions of dollars. You'd need to manage tenants, deal with repairs, handle mortgages. It's complicated and expensive. But what if you could own a piece of those apartment buildings, shopping centers, office towers, and warehouses without any of that hassle? That's exactly what REITs let you do. A REIT is basically a company that owns and operates income-producing real estate. They buy properties, rent them out, collect the rent, and then pay most of that rental income to you, the investor. What are REITs and how they work? Here's the beautiful part. By law, REITs are required to pay out at least 90% of their taxable income to shareholders as dividends. 90%. So unlike regular companies that might keep most of their profits, REITs have to share the wealth. This makes them incredible income-generating investments. There are different types of REITs. Some focus on apartment buildings, some on office buildings, some on shopping centers, some on industrial warehouses, and some even specialize in things like cell phone towers or data centers. And here's the kicker. REITs trade on the stock market just like regular stocks. You can buy and sell them instantly, no closing costs, no real estate agents, no paperwork. Just click a button and you own real estate. The income generation machine, the average REIT pays dividend yields between 3 to 6% and some even higher. That's significantly better than most bonds and way better than any bank account. Let's say you invest $15,000 in a diversified REIT fund paying 5% annually. That's $750 a year in dividend income, paid quarterly. And unlike physical real estate, you're not dealing with broken toilets at 2 in the morning or chasing down rent payments. With one investment, you could own pieces of hundreds of different properties across the country. Office buildings in New York, apartment complexes in Texas, shopping centers in California, warehouses in Florida. Instant diversification. This is exactly why wealthy investors love real estate. It produces cash flow. REITs give you that same cash flow without the headaches of being a landlord. Risk note. Now let's talk risks. REIT values do fluctuate. When interest rates go up, REITs often go down because borrowing costs increase. When the real estate market struggles, REITs can struggle too. They're not as stable as T-bills or savings accounts. Also, the dividend income from REITs is typically taxed as ordinary income, not at the lower capital gains rate, so keep that in mind for your tax planning. For beginners, I recommend starting with a REIT index fund rather than individual REITs. Something like the Vanguard Real Estate ETF gives you exposure to over 150 different REITs in one investment. You get diversification across property types and geographic locations, which reduces your risk significantly. Real estate has created more millionaires than probably any other asset class. REITs let you tap into that wealth building power starting with just a few $100s. That's asset number 4. Now, let's get to asset number 5. And this one might surprise you. Asset number 5, precious metals, gold and silver. All right, we've reached asset number 5, and this is the one that separates amateur investors from the truly wealthy. We're talking about precious metals, specifically gold and silver. The ultimate wealth protection here is something powerful to understand. Gold has been considered valuable for over 5,000 years. Empires have risen and fallen. Currencies have come and gone. But gold? Gold has always held value. When the Roman Empire collapsed, their currency became worthless. But the gold? Still valuable. When the German mark hyperinflated in the 1920s, paper money became toilet paper. But gold? People who owned gold survived. This is why central banks around the world hold massive gold reserves. This is why billionaires keep a portion of their wealth in gold. It's insurance against economic chaos. Why gold has lasted 5,000 years? Gold doesn't pay dividends like stocks. It doesn't pay interest like bonds. So why do smart investors own it? Because gold protects your purchasing power when everything else falls apart. When inflation spikes, gold typically goes up. When the stock market crashes, gold often holds steady or increases. When governments print too much money and currencies lose value, gold maintains its worth. Think of gold as financial insurance. You hope you never need it, but you're sure glad you have it when things go wrong. Kevin O'Leary recommends keeping about 5% of your investment portfolio in gold, not 50%, not 0%. 5 to 10%. It's the safety net for your wealth. Silver, the overlooked opportunity. Now let's talk about silver for a second. Silver is like gold's younger, more volatile sibling. It has all the precious metal benefits of gold, but it's also used heavily in industry, solar panels, electronics, medical equipment, batteries. This dual purpose makes silver more volatile. It can swing up and down more dramatically than gold, but that also means more potential upside. When precious metals rally, silver often outperforms gold significantly. For people just starting out, silver is more accessible because it's cheaper per ounce. You can start building a position with less money. How to invest in precious metals today? You've got several options for investing in gold and silver. First, you can buy physical gold and silver, coins, bars, bullion. You own it, you hold it, you store it. Some people love this because it's tangible. The downside is storage and security concerns. Second, you can buy gold ETFs like GLD or silver ETFs like SLV. These funds hold physical gold and silver, and you own shares of the fund. It trades just like a stock. This is the easiest option for most people. Third, you can invest in gold and silver mining companies. These stocks can give you leveraged exposure to precious metals prices, but they're riskier because you're betting on the company's management too. Start simple. Take 5 to 10% of your investment portfolio and put it into a gold ETF. You can buy it through any brokerage account in seconds. This isn't about getting rich. This is about protecting the wealth you build with the other 4 assets we've discussed. When economic uncertainty hits, when inflation runs wild, when markets panic, you'll be glad you have this protection. Every wealthy person I've ever studied owns some gold, not as their whole portfolio, but as their insurance policy. And that's asset number 5, folks. Now you know all 5 assets the rich use instead of keeping cash in the bank. All right, let's bring this all together. We've just covered the 5 assets that Kevin O'Leary and other wealthy investors use instead of letting their cash sit in a bank account losing value to inflation. Asset number 1, Treasury Bills giving you 4 to 5% returns backed by the US government. Asset number 2, high-yield savings accounts earning you 10 to 15 times more than traditional banks with the same safety. Asset number 3, dividend-paying stocks, creating passive income that grows over time through the power of compounding. Asset number 4, REITs, letting you invest in real estate and collect rental income without being a landlord. And asset number 5, precious metals like gold and silver, protecting your wealth when everything else falls apart. Here's the truth that nobody tells you. The difference between staying broke and building real wealth isn't about how much you make. It's about what you do with the money you have. Rich people don't work harder than you. They just know where to put their money so it works for them instead of sitting there dying a slow death in a bank account. You don't need millions to start. You can open a Treasury Direct account today with $100. You can start a high-yield savings account in 10 minutes from your phone. You can buy your first dividend stock or REIT share this week. The tools are available. The question is, will you use them? So here's what I want to know. Which of these 5 assets are you going to try first? Are you going with the safety of T-bills, the convenience of high-yield savings, the passive income of dividends, the real estate exposure of REITs, or the protection of precious metals? Drop a comment below and let me know your game plan. And if this video helped you see money differently, smash that like button and subscribe to the channel. We drop new wealth building content every single week that actually works for regular people. Hit that notification bell so you don't miss the next one. I'll see you in the next video. Until then, stop letting your money sit in the bank and start putting it to work. Let's build some real wealth together.